Group life insurance is a type of life insurance offered by a plan sponsor, such as an employer or an association, to a group of people with a common affiliation. While group insurance can include various benefits like medical, dental, and disability, this chapter focuses specifically on the life insurance component. How group life insurance works. A group life insurance plan is governed by a master contract between the plan sponsor and the insurance company. The plan sponsor, often called the policyholder, owns this contract. This means that the individual plan member doesn't have a direct contract with the insurer and has limited control over the policy, other than naming a beneficiary and potentially purchasing extra coverage. Instead of a copy of the master contract, the plan member receives a benefit booklet outlining their rights and benefits. How? Employees, managers, or executives of a specific employer. Alumni of a university. Members of an occupational, business, or retail association. For employer-sponsored plans, new employees are typically eligible after a probationary period, also known as a waiting period, which is often around 3 months. Some employers automatically enroll eligible employees, while others make it optional. If enrollment is optional, employees have a limited enrollment period to join without providing evidence of their health, also known as insurability. A key requirement for these plans is that the employee must be actively at work on the day their coverage begins. Premiums and taxes. Group life insurance premiums are calculated based on the demographics of the entire group, not on individual factors like age, gender, or smoking status. The premium rate is usually recalculated annually to reflect changes in the group's demographics, such as an increase in the average age. For most plans, the employer is required to pay at least 50% of the premiums, though some pay the full amount. If the plan is contributory, meaning employees pay a portion, the employer deducts the employee's contribution from their pay and remits the full premium to the insurer. Here's how premiums are treated for tax purposes. Employer. Premiums paid by an employer are a deductible business expense. Employee. Employer-paid premiums are considered a taxable benefit for the employee. Employee-paid premiums are not tax-deductible. Death benefit. Any death benefits paid out are not taxable to the employee, their estate, or the beneficiary. Group life insurance premiums are also subject to 2 types of taxes. A provincial insurance premium tax, which ranges from 2% to 5%. Provincial retail sales tax in some provinces, such as 8% in Ontario, 9.975% in Quebec, and 7% in Manitoba. Types of group life coverage. Most group life insurance is a form of yearly renewable term insurance. Unlike individual policies, the amount of coverage is dictated by the plan's terms. Schedule of benefits. The base coverage level is set by a schedule of benefits within the master contract. If the plan has different membership classes, e.g., management versus clerical, each class may have a different schedule. Common formats for the schedule of benefits include earnings multiple. Coverage is a multiple or fraction of the member's base salary. Flat rate. All members receive the same amount of coverage, often used for unionized groups with hourly wage earners. Length of service. Older plans may offer coverage based on an employee's time with the employer, but this is rare today. Combination. Some plans combine multiple factors, such as providing an earnings multiple for salaried employees and a flat rate for hourly employees. Plans often cap the maximum coverage amount, especially for highly paid employees. To keep costs down for the entire group, some plans reduce coverage for older or retired members. Types O. Because a member who is at a higher risk of death is more likely to buy additional coverage, a phenomenon known as adverse selection, insurers usually require evidence of insurability. However, some plans waive this requirement if the member enrolls within a specific timeframe after becoming eligible. While the employer typically contributes to the base plan, the member usually pays the full premium for optional coverage. Some plans also allow members to purchase optional coverage for a spouse, separate from any dependent life coverage. In rare cases, permanent life insurance may be offered as an optional benefit. Dependent life coverage. Most plans offer optional life insurance for a member's dependents, usually without requiring proof of insurability if purchased shortly after joining the plan. The definition of a dependent typically includes a spouse and children between 14 days and a certain age, e.g., 18 or 21. The death benefit for dependents is modest, typically between $5,000 and $20,000 for a spouse, with 50% of that amount for each child. The premiums for dependent coverage are often higher than for an individual policy due to adverse selection, but because the coverage amount is low, the annual premium is quite small. Dependent. Survivor income benefits. A monthly payment to a surviving spouse or children. Accidental death and dismemberment. AD&D, an extra benefit paid if a member dies from an accident or loses a body part or function. This can be a basic benefit automatically included or a voluntary add-on. AD&D benefits do not require evidence of insurability because they are only paid for accidents. Common exclusions include self-inflicted injuries, war, and impaired driving. Group creditor insurance, offered by financial institutions to borrowers to cover a loan, most commonly a mortgage. The financial institution is the policyholder and the borrower is the plan member. The death benefit is usually limited to the outstanding debt, and the financial institution is the beneficiary. Conversion privileges. A group member generally has the right to convert some or all of their group life insurance to an individual policy with the same insurer without providing proof of insurability. This applies if they leave the plan due to retirement or changing employers, are no longer a member of the sponsoring organization, the plan itself is terminated. In Quebec, specific laws protect a member's conversion rights. In the rest of Canada, the industry follows guidelines from the Canadian Life and Health Insurance Association, CLHIA. Under these guidelines, a member can convert up to $200,000 of their coverage to individual insurance by age 65. When converting, the premiums for the new individual policy may be higher than a brand new policy due to adverse selection and the lack of medical underwriting. When you're trying to understand the difference between group life insurance and individual life insurance, it helps to look at a few key features. The biggest differences have to do with who owns the policy, how premiums are calculated, and what the coverage looks like. Ownership and premiums. With a group life insurance policy, your employer or a plan sponsor owns the policy, not you. The premiums are determined based on the demographics of the entire group, which means they're usually more affordable, especially for those who might have health issues. People in poor health can get coverage at an affordable rate, whereas with an individual policy, they might be denied coverage or have to pay much higher premiums. The premiums for group plans are guaranteed for 1 year at a time. In contrast, individual life insurance is owned by the policyholder. The premiums are based on your personal health, and you'll have to provide evidence of your insurability. The premiums can be guaranteed for a specific term, such as 5, 10, or 20 years. Coverage and insurability. With group life insurance, evidence of insurability generally isn't required during the enrollment period. The coverage amount is dictated by the plan, is usually limited, and rarely continues past age 65. With an individual life insurance policy, evidence of insurability is required. The coverage can be customized to your specific needs and can provide term coverage until age 75 or 80, or even permanent coverage until death. Advantages and disadvantages of group life insurance. Advantages. No medical exam or proof of insurability is required, which benefits those in poor health or smokers. Premiums may be fully or partially paid by the employer. Convenient for the employee. Coverage can be converted to an individual policy without proof of insurability if the plan terminates or the member leaves. Disadvantages. Individuals in very good health pay the same premiums as the rest of the group. The employer or plan sponsor controls the policy and can make changes without consulting members. The coverage amount may not meet the member's individual needs. Premiums for a converted individual policy may be higher and are not guaranteed. Employer-paid premiums are a taxable benefit to the employee.